Corporate framework to maximize mortgages and minimize tax. So who is this for? It's going to be for corporate business owners and real estate investors. More specifically, corporate business owners who are real estate investors. Well, the first thing I'm going to do is just explain what I've been up to since 2015. 2015, I had my first kid, so I moved my family out to Langley and we bought our first row house. In 2016, I was involved in a 3-lot assembly, and one of those lots was this property for development. In 2018, moved my family out to Vancouver Island. At the time, you could actually buy $1 million property for $1 million. So I thought, why not? I basically work from a computer anyways. In 2019, I saw what was going on with development out in Victoria. I then partnered with a friend of mine, and we bought this property. We bought this property. We then bought this property. And then 2020, we bought this. We bought this. We bought this. And then 2022, we bought this, bought this. And then from 2021 to 2023, we built a 40,000 square foot condo rental building that we have been able to keep with CMHC. And then we were planning on building this one, which is 120,000 square foot, 114 units. But due to the risk tolerances that we've experienced building our first building, we are actually now in the process of selling off the land and probably focus more on building smaller buildings down the road. Since 2015, 11 properties were purchased, a 40,000 square foot condo rental building was built, and 120,000 square foot condo rental building land assembly is now in the process of being sold. Why do I show this to you? Is because I want to show you what income I personally qualified with to do all of this. On average, about $45,000 to myself as a dividend, $45,000 to my wife as a dividend. Personal tax is around 2%. My corporate tax bill was around 11, and I paid nothing in Canadian pension plan. How is this possible? The two things that we're going to do is we're going to go through what the fundamental problem is, and then we're going to talk about the framework that I use to solve that problem. What's the fundamental problem? In your life, you're working with a residential banker. You can have residential mortgage brokers, commercial bankers, commercial mortgage brokers, life insurance agents, corporate lawyers, accountants, realtors, financial advisors. The challenge with all of these people are they are not connected together. They do not talk to each other. But relative to your financial position, they are 100% connected together. And the person that's responsible for connecting them all is you. The only challenge with that is you're probably not that good at it. Let me give you some examples. What are some questions that are impossible to answer from a singular industry's point of view? How do you optimize your real estate purchase so it does not lock up your future financing options? Most people go and ask for what can I get pre-approved for? What you should be asking is, what you get pre-approved for, but how does this affect my current portfolio that I own? And how will this affect my future portfolio or my future financing options down the road if I buy this property? Who's involved in this? Corporate lawyers, accountants, realtors, commercial mortgage brokers, commercial bankers, residential mortgage brokers, residential bankers. All of these people are involved in really mapping out the answer to that question. How do you structure your company income in order to qualify for a 0% down commercial loan for your business? Well, first of all, I don't think most people realize that your business can actually qualify for 0% down commercial property. It's definitely possible, but your financial structures have to be designed in a very specific way in order to do so. Who's involved in that? Corporate lawyers, accountants, realtors, commercial mortgage brokers, commercial bankers. How do you get down payments out of your residential properties in order to qualify for your commercial purchases? Well, this is actually a balancing act because if you pay out too much out of your corporation to your personal self to qualify for the residential loans, it actually devalues how much commercial lending you can get access to. So it's actually a balancing act between both. And it's a balancing act between years because you might structure yourself for last year to structure yourself for qualifying for residential, but then position yourself the next year to qualify for maximum commercial. So it's pretty much a game that has to be played. Who's involved in this? Accountant, commercial mortgage broker, commercial bankers, residential mortgage brokers, residential bankers. How much money do you need to pay out of your company in order to qualify for the exact amount of mortgages you need for this given year? This is an equation that you pretty much want to answer every single year in order to qualify for lending. But the funny thing is, it's actually a trick question, because if you were aware of something called private banking, you could actually pay nothing out of your company to your personal self. And that private banker would just use the net income of your corporation as your income. So in terms of a corporate structuring point of view, in terms of minimizing tax being paid, this is one of the most important things that has to be set up, which is private banking. So who's involved? Accountant, realtor, commercial mortgage brokers, commercial bankers, residential bankers, and also private bankers. What are the problems with trust agreements when it comes to future residential financing? The challenge with a trust agreement is you basically just change ownership of the property to another company without disclosing it to the bank. And when you plan to refinance that down the road, that can create problems. The challenge is that accountants and lawyers do this all the time without understanding how the banks are going to consider this. So who's involved in this? Corporate lawyer, accountants, residential mortgage brokers, residential bankers. Should I buy residential property in a holding company or my personal name? So if you're incorporated, 99% of the time, you want to be owning that residential property in a holding company in your corporate structure. If you're not incorporated, then I would say that most people are just going to own it on the residential side. But overall, who's involved in this question? Corporate lawyer, accountant, residential mortgage broker, residential bankers. If you have a commercial loan, how do you make sure the commercial bank does not call your loan? So I'll give you a pretty extreme example. I had a client of mine, quite a significant operation. They had a $3 million operating line to deal with payroll. And for about 2 years, they had a pretty bad couple of years. And what he ended up doing is he ended up finding a property he liked to buy, but then he took the money out of the company and bought that property. So when the annual review came for this $3 million line of credit, he failed. And the bank actually took that line of credit back. And he had to go get a private line of credit. So at the time, his current line of credit rate was 4%. At the end, with the new private, 35%. So it took him about a year or two to fix everything way the bank would want it to get that original lending back. So with commercial, you really have to understand what they're looking for and to make sure that you don't put yourself in a position where they call your loan, because that's the last thing on planet Earth you want with commercial. So who's involved with this? Corporate lawyer, accountant, commercial mortgage broker, commercial bankers. How does a corporate general securities agreement for commercial financing affect your operating company? If you're using your corporation to qualify a commercial loan, they're going to want this general securities agreement. The challenge with that is if you go to a different bank and you want a loan from them, they most likely will want that GSA also. If they can't get it, they might not give you that loan. So there's a bunch of management or understanding that you want to have with commercial. I'd say the main point is that you want to be dealing with a bank that's going to allow your cash flows to be used not just for the purchase of a property where your business runs out of, but it also can be applied to all the other rental commercial properties that you own. The funny thing is most banks don't allow that. So you want to be actually working with a bank that does. So who's involved in all of this? Corporate lawyer, accountant, commercial bankers, commercial mortgage broker. Where do you place your life insurance policy in your corporate structure? So over time, I've seen this placed incorrectly all over. I'm not going to go into detail on that, but who's involved in this? Life insurance agents, corporate lawyers, accountants, financial advisors. So there's one thing to answer these questions. It's an entirely different thing to even know to ask them. So what is the solution? So here you are, responsible for connecting all of the dots between all of these industries. What happens if you just put me there? So let's look at my background. Residential mortgage broker for 15 years, commercial mortgage broker for 8 years, life insurance agents for 24 years. I got my life insurance license when I was 20 years old. Corporate lawyer. I've been dealing with the corporate legal side for 12 plus years with lots of clients and for myself, dealing with accountants all day long, about 15 years worth. Realtors, dealing with realtors over 15 years. I understand the financial advisor side of what they do for about 22 years, and 30 plus residential bankers that I work with. And I got about 30 commercial bankers that I work with. But the most important thing I did, really since I would say 2009, is I figured out how to connect all of these dots together. And that allows me to make decisions from a singular point of view and optimize everything. Let's now go to the framework that I use. And this is going to be the baseline of the framework. There's a lot more behind this, but this will give you a decent understanding of the perspective that I'm coming from. Corporate income, personal income. And there's a line between both of these. When you make money on the corporate side, when it gets transferred to the personal side, it becomes less. Why? Because you got to pay tax. One of our main objectives is how do you structure everything you own so you're paying the absolute least amount of money from your corporate side to your personal side, while at the same time being allowed to qualify for the absolute max amount of mortgages and to buy as much real estate as you could. You got an operating company, small business, I'm assuming less than $500,000 net income, you're paying 11% tax. You're going to pay out a dividend every single year to your personal self. There are 3 calculations on how much dividend you should be paying. One is $37,000 with probably around 0% tax, is zero-ish. 2 is based on mortgage qualifying. 3 is what your lifestyle is. For this video, we're just going to be talking about mortgage qualifying. Now, before I go into this analysis, I'm going to talk about dividends. Should you pay a dividend or should you pay salary? Well, let's look into it. Why dividends? Well, CPP is based on salary. 50% by the employer and 50% by the employee. But if you are self-employed, you pay both. And today that's around $7,500 a year. Between myself and my wife, that would be $15,000 a year. Dividends are considered profits from a business and are not salary. Therefore, CPP does not apply. Therefore, I do not have to pay Canadian Pension Plan. What happens if I just invested that $15,000 a year myself? If I had $15,000 a year at 30 years at 6%, that's $1.2 million. 15,000 at 30 years at 8%, it's $1.8 million. How about at 10%? It's $2.7 million. Now, the best one is this. What happens if I paid this for 15 grand a year for 30 years with the Canadian Pension Plan and I die? Now I'm in my 60s, I'm going to die. How much do I get? I get 2 death benefits for me and my wife, $2,500 each, which equals $5,000. There's some math. On top of that, there's no payroll, therefore no remittance. When you pay salary, you can't reverse it. You can reverse the last 2 years of dividends paid, allowing you a lot more strategical movability. You can pay dividends whenever you like, generally at corporate year end. This allows you to choose the exact amount of money you want to pay yourself. You get a 15% gross up on notice of assessments. So that means if you just paid a $50,000 dividend, it actually shows up as an income of $57,500, allowing you to qualify for more mortgages. Now, is there a downside? Yes, there is. There is no CPP retirement plan up to $1,300 a month at age 65. This assumes, I think you deposit over 40 years worth. There's no disability insurance up to a maximum of $1,000 a month. So my suggestion, purchase private disability instead, which is what you should be doing anyways. Who should not use dividends? Well, if you're dependent on the Canadian Pension Plan for retirement, then I would not be using dividends, I'd be paying salary. So dividend summary, it's cheap and super flexible. So now let's go back to mortgage qualifying. So every residential property you own has to be requalified every year in order to qualify for more mortgages. This is actually a bit false because it's not every year. It's actually every time you apply for a new loan, all of your residential loans have to be requalified. Let's look at the income required for purchasing this house. Mortgage payment plus property taxes plus strata plus heat divided by the total debt service ratio, which is the percentage of income you're allowed to use to qualify for a loan. If the mortgage payment in this scenario is $3,167 a month, we add property taxes of $400 a month. There's no strata in this one, but there's going to be heat of $100 a month. And we're going to times that by 12 months. We're then going to divide it by 44%, meaning 44% of our income is allowed to be used to qualify for this loan. So now we got $44,044 divided by 44%. This means this property consumes $100,000 of your personal income every time you qualify for a loan. So this property now consumes 100 grand a year to start. But now you want to buy a rental property. Let's look at the math of a rental property. And I'm going to assume I'm using best lenders for this, for the best calculations. So we got mortgage payment plus property taxes plus the strata minus 80% of the rental income that property produces divided by your total debt service ratio. So $23.63 a month would be the mortgage payment plus property taxes of $100 a month, strata of $270. Then we're going to minus 80% of the $2,500 a month that this property could produce, times this by 12. And now we're going to divide this by your total debt service ratio of 44%. Now, $8,800 a month is the final number, divided by 44. We're now at $20,000 a year. So this means that this property consumes 20 grand a year. Now, obviously, you don't want one rental property. You probably want to buy two. So you buy the second. And what also happens is most likely there's a property down the road that it's in your neighborhood and you like it. And it may not be a great investment. It's a bigger house. The cash flow is not that great. But now that property consumes $50,000 a year. So this portfolio, before you even start borrowing another dollar again, consumes 190 grand of personal income before you even think about buying another property. And this is the trap of residential financing. The worst scenario I've ever seen is a client of mine had a principal residence house and it cost around $200,000 a year of income just based on how big the mortgage was, which is fine. The challenge, though, was he went and bought properties similar to his principal residence, which are great properties to live in, but are bad rental properties. And mathematically, it consumed 100 grand a year, each of them. So he ended up buying 1, 2, 3. What that meant was he'd have to pay out at the time $500,000 a year of personal income, or he had to have a $500,000 income to basically borrow a single dollar more. So I'll give you an example of my scenario. By design, because I understand these numbers, my principal residence house consumes $70,000 a year. And the rentals that I buy either consume $0 per year or $10,000 a year. So when I showed you my income of paying out $90,000 a year combined between me and my wife, that's because I didn't buy properties that were high income consuming type properties. So now let's change gears. Let's go back to the corporate structure. So you got this operating company and it's making money and you're paying 11% tax. The challenge, though, is you don't want to keep your money in your operating company because if it gets exposed to lawsuits, all of that money actually gets tied up. So what you want to do is you want to set up a main holding company. And every single year, we set up a dividend of all of the profit from the operating company being moved up into the main holding company. So now if anyone has any litigation against your operating company, there's no money in it. You want your operating company almost to be like a shell company where none of your assets are being held. Now, the main holding company is where you hold non-liability assets, such as cash, stocks, bonds, insurance, and no real estate, because real estate comes with liabilities. So how do you own real estate? Well, you take your money and you set up another holding company and you buy your real estate in that holding company and you transfer the money from the main holding company to your real estate holding company for the down payment, as an example. The last thing you want to do is transfer this money across this line. Because if you do, for example, if you took out $200,000 from your main holding company and bought your property personally, 80,000 of it basically disappears to taxes. If it's held in the holding company, nothing disappears. So what you want is real estate holding company 1, real estate holding company 2, real estate holding company 3, real estate holding company 4, etc. Now, on top of residential, what's probably another good thing to look at is how commercial works. But what's great about commercial, if you hold commercial in your holding company, the income required for supporting that is not applicable. Banks ignore all of it. It's only with residential financing that you have to deal with this income qualifying component. For example, this property that we built takes $0 of my personal income. The 120,000 square foot building that we thought we were going to build would actually take $0 of income. So that's the power of commercial. There's also a superpower that I didn't mention here to deal with your operating company. Your operating company's cash flow can be used to support and guarantee other properties. For example, commercial properties with 0 to 10% down for your business. It also can be used for residential. So here's office space, here's retail, here's storage, land, and multi-unit residential. So what you want to do or realize is that your operating company can actually support qualifying with all of your real estate holdings. Now, if we were to look at the maximum value, what are we trying to optimize? Let's summarize this. We want to own really everything inside of holding companies. We want the operating company to support it when it's required. We want to keep all of our money in the main holding company. We want to pay out dividends every single year, basically based on mortgage qualifying. And we want to buy rental properties if we're going to buy residential rental properties that don't consume massive personal incomes for future qualifying. But let's say we want to go to the purest maximum value available. Let's say you actually wanted to own $100 million in real estate. So how is it done? Relative to this structure, you just don't buy residential properties. Residential properties are not scalable. You buy commercial and you use your operating companies to support it when it needs to be supported. Is there more? Yes. It's possible to buy whole life in a main holding company. What this will allow you to do, it'll allow you to get a line of credit on your personal name associated with that whole life contract. Banks that do this are TD, BMO, RBC, CIBC, Scotiabank. They have entire divisions devoted to this. Why do you want to do this? Well, it's a tool to get access to your retained earnings on the personal side without paying tax through lending. What's the problem, though, with whole life? It's extremely expensive and extremely restrictive. What's the solution? Manulife. Manulife came out with a product that allows you to use 95% term insurance with a 5% whole life rider, which will do the exact same thing as 100% whole life would do. So what does that mean? It means it becomes extremely cheap and extremely flexible, to the point that if you are already paying for term insurance and you add a whole life rider to it and own it in your holding company, you can implement this strategy. So is there more on top of that? Well, there's a ton more. It's an entirely different thing to implement it. So how does it work? First thing we're going to do is we're going to map out your corporate mortgage real estate org chart. We're going to start with a blank piece of paper or a blank sheet, and we're going to end up with an entire corporate structure mapped out. That's part one. Part two, we're going to build a task list or a to-do list of everything that needs to get fixed. Three, we're going to take this list and the corp structure, and we're going to go to the accountant and maybe the lawyer, and we're going to finalize it. My process, I usually get people to around 90%. The accountant will finish it off to 100. At the end, all of your future financial decisions will then be made from this chart. The next thing we're going to do is we're going to build out something called a net worth 100. So once you have your corporate structure and your plan mapped out, we're going to figure out what you're going to be worth till age 100. What's amazing about this process is what happens over 20 years. What happens with inflation of owning real estate over 20 years? What happens with just mortgage pay down over 20 years? What happens with business values and retained earnings and all of that? Because most people only look through the perspective of today. They don't actually project out 20 years. We can actually build correct planning around what we can expect to happen over time. So the net worth 100 becomes a very powerful tool to understand, the game plan. The next thing we're going to do is use lender analysis. And we're going to look at all of your residential properties and actually convert them to income amounts and figure out if you should be continuing on purchasing residential properties, or maybe you should be looking at commercial. And also, we can also analyze, which properties you may want to sell if you actually want to continue buying residential. And also, we'll also determine which residential should you be buying. And then the most important part, I would say the most important part, but one of the super important parts is structuring your financial position to get into private banking, which is the highest level of banking in the banking system. So if you're worth $100 million and you make $4 million a year, you already got private banking. But what happens if you're not worth 100 million and not making $4 million a year? How can we get you in? So one of the things that we'll do through this whole structuring process is we will position yourself to get in. And the great thing is once you're in at one bank, they can't kick you out. You have full access to all the services they provide, and it is the absolute best stuff available for residential financing. here's pretty much all the stuff that we are going to do. At the end of the game, you're going to have two things. You're going to have an optimized plan, but way more important, you're going to have a team that will implement that plan. So it's not just a checklist of what to do and you never get around to it. No, it's actually the whole thing is done. Next step, send me an email to robert@robertklein.ca. My number is 778-896-6732, or put up your phone and scan. You can set up an appointment right away. Any questions, let me know.